Plato once said, "Only the dead have seen the end of war." There have been hundreds, if not thousands, of wars in the last 2000 years, and unfortunately, they are a reality we must face in our lives. Firstly, I want to start by acknowledging that war is a tragic thing and its impact on human lives is absolutely horrible. But it's a reality we live in, and there's not much we can do about it. I also want to stress upon the fact that I'm no expert in wars or any geopolitical matters. I only watch some historical content because I find it interesting. But of course, as an investor in the markets, I have to pay attention to what's happening around the world, and today in this video that's what we'll be looking at: wars from an investor's perspective. My main goal with this video is to share some facts and to make sure that you don't panic when things go south in the world. Let's begin. So before we get to the main parts of the video, let me begin by giving you a summary or the key takeaway from this video. Investors with a time horizon of years rather than days or months shouldn't worry excessively about wars. Markets ultimately adjust to new realities. Both humanity and companies demonstrate remarkable resilience. And overall, no matter what the initial reaction is, markets eventually recover and keep going higher over a period of time. At least that's the lesson that history has taught us. So there you have it, the key takeaway of the video, if that's what you needed to hear. In case you're closing the video, please drop a like before you do that. For others, let's look at this topic a little deeper. Let's start by looking at what happens when a war or a major conflict breaks out. Generally speaking, these lead to immediate negative reactions in stock markets. During World War I in 1914, Dow fell over 30% and markets closed for 6 months. During the attack of Pearl Harbor in 1941, Dow dropped over 6.5% in a day. During the Cuban Missile Crisis in 1962, S&P 500 fell over 9% in just 2 months. If you look at 9/11, stocks fell over 15% in the following days. And during the recent Russian invasion of Ukraine in 2022, we saw a 7% drop in S&P 500 in subsequent weeks. And even this week, as the war in the Middle East escalated, markets fell as history has shown us in all the other examples. We'll soon get to what happens in the longer term, but let's look at some factors that play a key role in the markets going down. A lot of these will seem quite obvious, but it's good to know the factors that you should always be aware of in such times. The first one is uncertainty about the economic impacts. A good example of this is that any crisis in the Middle East has an immediate impact on the oil prices. This is for the obvious reason that a lot of oil gets produced there. Make sure to account for this whenever there's disturbance in that area. The next one is a fear of supply chain disruptions. This was also recently demonstrated during the Middle East crisis. Supply chain disruptions can actually happen for various other reasons as well, but during times of wars, this does play a key role. This is actually one of those things that can have a lot of impact on a lot of different companies. The next one is concerns about inflation and interest rates. Again, because of the previous two factors, inflation can actually tick up quite quickly during these times. Also, interest rates can actually play a role in a positive or negative direction when it comes to times of war. This is something that you need to take in step by step. You'll see it unfold as the conflict unfolds as well. But the reason the market reacts negatively is because this also adds a lot of uncertainty in the market. The next one is potential for reduced consumer spending. Now, there might be a reduction in consumer spending just because people are scared and don't know what's happening. A lot of people might just wait to see how things are escalating and how things like oil prices are being affected because of the conflict. Yes, this is also something that needs to be monitored step by step, but it further adds to the uncertainty in the market. The last one is something we have discussed already, but this is something I also wanted to stress separately. That is worries about energy prices, especially in oil-dependent economies. I wanted to highlight this again simply because of how important energy prices are and how it impacts everything else in the economy. If oil prices go up, it can have a much broader impact on a lot of different parts of the economy. I really want to encourage you to read more about this topic, or maybe I'll cover it in a separate video. For now, let's look at the longer term trend. Historical data reveals a counterintuitive pattern. Markets often recover and even thrive during wartime. Yes, you heard that right. Markets can continue going up during times of war. In fact, just look at the last 2 years. Markets have been constantly going up after bottoming in 2022. And throughout all this, we actually have two major conflicts going on. But let's look at the history a little bit more. During World War I, Dow rose 88% in 1915 after markets reopened. By the end of the war in 1918, Dow was up 43% from pre-war levels. Same thing happened during World War II as well. From 1939 to 1945, Dow gained a total of over 50%. That's over 7% annually. And the S&P 500 averaged 15% annual returns during this period. Yes, 15%. That's more than the average S&P 500 returns over the last 100 years. It almost sounds made up, but that's what happened. Even if you look at the Vietnam War, the S&P 500 gained 43% between 1965 and 1975, and certain defense and technology stocks saw significant growth. And post 9/11, markets recovered initial losses within a month. And even during the recent invasion of Ukraine by Russia, the markets actually started recovering within a month. But then the markets ended up going down, but it had less to do with the war and more to do with interest rates and the general economy. Yes, we see that markets recover quite successfully after the immediate reaction, but why does this happen? One of the historical reasons is that during major wars, government spending actually ends up stimulating the economy. Increased defense budgets often end up boosting certain sectors, and war bonds and other financial instruments end up creating investment opportunities. So here's the thing about good investors, they'll find opportunities no matter what's happening out there. But for you, if you cannot do that, what you should be doing is investing in something like the S&P 500 and sticking to it. Of course, I'm not saying that you shouldn't try to play the markets and figure out where you should go when something bad is happening out there. You can totally do that. You can try exploring the defense sector if you're early enough, that is. It does come with a moral component, but it's really up to you. Do whatever you feel is right for you. The next one is the most obvious one, that is investors adjust to new geopolitical realities. As we saw, the immediate reaction is often due to the uncertainties in the market. As the initial shock wears off, investors try to figure out what to do next, and markets price in known risks now. The next reason is human and business resilience and adaptation. Businesses often find ways to operate in new conditions, and innovation actually accelerates during times of crisis. This is something we have seen a lot in the past. A lot of new inventions came out of World War I and World War II. Innovation also occurs during other times of crisis, as we saw during the recent pandemic as well. Overall, don't underestimate what humans can do and how they can innovate in bad times. Talking about adaptation brings us to another point that plays a major role in more modern markets. That is global diversification of markets. Nowadays, localized conflicts have lesser and lesser impact on global indices. International trade and supply chains have become quite adaptive. Even more recently, we have started seeing that a lot of companies are shifting their supply chains based on the recent events during the pandemic. This is significantly rewiring how things will work over the next couple of decades, and these things happen during crisis and they will continue happening. This is also something that's not in your hands, so you shouldn't worry about it. You should let the companies do what they do best, that is innovate and adapt. The next point we are going to talk about is the most important point for retail investors like you and me. This is that there are several other factors that play a larger role in the long term. These are your corporate earnings, interest rates, technological advancements, and demographic trends. These are basically all the things we look at when we decide to invest in a company, and this is what you should be focused on even during times of crisis. Find good companies and invest in them. If you don't want to put in that much work, just invest in the S&P 500 and you should be fine as well. Yes, it goes without saying that you might see some short-term pain during these times, but you have to learn to weather them. This is part of your investing journey. Talking about how to weather these times brings us to the last section of this video, that is what exactly should you do during these times. The first is to avoid knee-jerk reactions. This is something we all have done at some point, that is panic selling during a crisis. I did that during the Russian invasion as well. I sold some of my assets not because I was scared, but because I was actually trying to time the market and trying to buy back lower. But again, it was a knee-jerk reaction and I paid the price. What we should generally do is look at buying opportunities during times of crisis. Just focus on the good assets and try to buy them at lower prices if there are knee-jerk reactions by other people. There are plenty of opportunities in the market right now as well. The war has definitely scared some people out of the market and we are getting some good prices on some of our assets. You should try to see which ones are worth buying and just buy them. The next one is to always stay diversified. One of the best ways to weather these storms is actually to have a good, well-diversified portfolio of different stocks and different assets as well. You should have a good mix of ETFs, stocks, gold, and even Bitcoin if that's something you're into. Now, even something like gold and Bitcoin are not completely immune to such times, but they are good insurance policies for the worst case scenario. The next one is to consider the economic strengths of the country you are located in. In my case, it's Canada. When in doubt, just look at your own location and figure out how everything is impacting you directly. It might be harder for you to go global and figure out what's happening, but you can always invest in your own strengths. For example, in Canada, natural resources can actually perform well during conflicts because we have plenty of it. Also, something like the banking sector in Canada, which is quite strong, can provide stability as well. The next one is to consider the impact on your currency. Wars can significantly affect currency values, so make sure you're diversified across currencies as well just to mitigate risk. For me, the best thing to do during such times is to actually be in the US dollar as much as possible. In fact, a lot of my assets are also in the US because of the same reason. No matter what you think, US is the powerhouse and that's the currency that holds up value during times of crisis. The last one is to maintain a long-term focus. As we saw in several examples, the immediate reaction becomes irrelevant in the longer term because the market tends to go up over a period of time. As long as you stay well diversified and stick to your investment plan with a long-term focus, you should come out on top eventually. You should remind yourself that investing is a lifelong journey and not something that should be treated as trading. In this video, we are talking about investing. Of course, very different rules will apply to your trading strategies. So those were some of the things I wanted to talk about in this video. Yes, war is tragic, but the long-term impact on the market is actually less severe than expected. There are 3 rules here that can actually help you. The first is to stay calm, focus on the long-term goals, and also stay diversified in the process. Use historical context to make informed investment decisions, and finally remember that past performance doesn't guarantee future results. Yes, the last one is also important. It's because we are living in an ever-changing world. Even though we can study the past, things may not exactly work out the same way. But also remember that the 4 most dangerous words in investing are "this time is different." On that note, I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.